Hope everyone is having a lovely day. This is a bit of an unusual event. I don't do really live streaming really on this channel. I did some in the early days of the channel, but hold on just a second. I was previewing the audio here. All right. Yeah, just making sure my audio was working. Sorry about that for those of you that had a little bit of feedback there. But yeah, so just testing out live streaming. But we've got a lot of folks on YouTube that really like the live streaming, the social aspect of you guys being able to ask me questions in real time. So I do want to occasionally do some of these live streaming events. So today, obviously, we're going to talk a little bit about options trading. We may talk a little bit about what's going on in the markets as well. Right now, not much is going on. Markets are essentially unchanged. The ES is up 10, the NASDAQ is down about 17, Russell up about 9, the VIX futures ticking down a little bit, so volatility is ticking down. Overall, though, not much going on in the markets today. Kind of a boring day in the market. For those of you that are new to options trading, today I wanted to, the title of the stream here, of course, is an introduction to the wheel strategy, right? So one of my favorite strategies, it involves selling cash secured puts in order to get long stock. And then once you get long stock, selling covered calls until assigned and your long shares get called away, and then restarting the wheel by selling cash secured puts again. All that doesn't make any sense. Well, we'll talk a little bit more about that. But if you're new, if you've got questions or comments, feel free to ask in the chat. I'm going to try to pay attention to the YouTube chat while I'm talking or doing any kind of presentation stuff. I may be a few minutes before I get to your question or comment, but I'll try to keep up. Obviously, super chats are always welcome. So if you've got a question, you want to make sure I see it. The super chat is the best way to guarantee I see it, because those things get highlighted, which can be useful, especially if we get a big crowd here. I don't know how many people will show up to this stream, but again, I didn't give you guys a huge heads up on this as well, but we've already got, a dozen people or so watching. So here in a few minutes, hopefully we get a little bit more. But today's topic is going to be about the wheel strategy. I may pull up some of my slideshows here from past videos, since I've got a lot of this stuff already covered in slideshows I've done on previous videos. At this point, we should talk a little bit about the year in review, as far as, I started this channel back in February. So we've only been doing this YouTube channel for about 10 months. I've made somewhere around 110 or 115 videos in those 10 months. So there's plenty of content on the channel. I put in a ton of work making all of those videos. Kind of as a side hustle here, right? It's not my main YouTube channel. I've got, my main YouTube channel. For most of you guys know, I got another YouTube channel called DistroTube, which is based around the Linux operating system. It's more of a technology kind of channel. And this was kind of a second channel because I do like trading, and sometimes I would talk about trading and other topics. It was one of those things, when you do YouTube, it's nice to have multiple channels, because you get to then talk about multiple different things in more appropriate places. It wouldn't make sense for me to talk about trading and investing on a technology channel. So, what I created, a financial channel for all of that kind of stuff. And it really has been great, because it allows me to, not really burn myself out by talking about the same things all the time. When you get multiple YouTube channels, I know a lot of people, when I decided to create this channel, people were like, well, isn't that going to be more work? You're going to have, well, in a lot of ways, it is a little more work, but it's also refreshing, to get to do new things. Also, it was kind of neat to start a new channel from scratch, right? It's like, hey, because it's always nice to build something, build something from the beginning again. Yeah, James is in the chat. Alex says hello. Narado says, hey, DT. Yeah, welcome aboard, guys. Yeah, for those of you that are unfamiliar with what the wheel strategy is, let's go ahead and get into a little bit about what is the wheel strategy. So the wheel strategy is a option strategy that is a system of selling cash secured puts and covered calls. And what's great about this, especially if you're kind of a newer trader, these kinds of trades, they typically have low risk if you trade them right, and they have a very high probability of success. Perfect for beginners. So, the wheel outperforms, it can outperform the traditional buy and hold strategy. Now, whether it actually will outperform will depend on a lot of different factors. So, and that's not necessarily gospel, that part, but you certainly have the potential to do better than just passive investing. Passively investing in something like buying shares of SPY, for example. And that's typically why people actively trade. You certainly can passively invest and just hold shares of SPY for the long term. Keep stockpiling shares of SPY. That's certainly a way to passively invest, and that's a smart thing to do. I think most people should be doing that. But of course, some people want to do more than just accept the standard market returns year after year. Some people want to beat the market. And if you want to beat the market, obviously that's where you have to actively trade rather than passively invest. Yeah, Sam in the chat. It's like, hey, DT, still in the gym finishing my workout. Yeah, I didn't go to the gym today because I had this stream to do, and of course I met with our Discord members this morning for our live voice chat. I could have, tried to squeeze in a quick little workout, but I took the day off from the gym. I typically go to the gym about 4 or 5 days a week anyway, so today will be my day off. But I'll go back tomorrow. I think tomorrow, I should have to do back and shoulders tomorrow. It's the next in the rotation for me. So back to options versus buy and hold. So the buy and hold strategy, your passive investment, that only makes money if the stock you're holding goes up. But the great thing about the wheel strategy is I can make money if the underlying goes up, trade sideways, excuse me, or goes down a little bit. So the cool thing about options is I don't have to be right on direction. At least most option strategies. There are plenty of option strategies that I could employ where I make money if the stock goes up, goes down, goes sideways. And that's really nice because a lot of trading, especially like the fake trading gurus on YouTube, they're doing everything directionally. It's either trying to day trade stocks, day trade futures, day trade Forex, and it's all you've got to guess direction. You've got to predict direction. And newsflash for you guys that are new to trading, no one can predict direction of anything. Markets are random. There is no way to consistently and accurately predict what the next candlestick of anything is going to be. So anybody trying to sell you that dream on YouTube or TikTok or anywhere else on the internet, it's all bullshit. Just call it what it is, right? Well, the great thing with options is we don't have to buy into all of, trying to guess the market, right? We don't have to do that. And that's why, really, if you want to be smart with your trading, the options game is kind of the game you really have to be in. You really don't want to be trying to guess where that next Forex candlestick is going to be as far as your Forex pairs or day trading futures and things like that, scalping futures. That's such a hard game to play. And really, it's an impossible game to win at in the end. So the wheel strategy, some people will call it the triple income strategy because it's got 3 profit-making components. You first start selling puts. Later, you start selling calls, and then, of course, while you're selling your calls, you're also holding shares of stock part of the time, so you're really making money 3 different ways with the wheel. So that's why some people will call it the triple income strategy. Really, it could also be called the quadruple income strategy because sometimes the stocks you're holding while running the wheel also pay you a dividend. The dividends are not going to be a big component of the wheel strategy, even if it's a high paying dividend, it's still going to be a minuscule amount of money compared to the money you're making on options premium as well as the share appreciation. So I wouldn't trade the wheel strategy specifically because you want dividend payments, but if the stock happens to pay a dividend, yeah, you will get dividends as well. So here is a little bit of a demonstration of the wheel, right? You begin the wheel by selling a cash secured put. So this is selling an typically an out of the money put, a short put. And when you sell a put with options, if it finishes in the money at expiration, meaning you're going to lose on the trade, well, in that case, you are required to purchase 100 shares of stock at the put strike price. So this is why this is the beginning part of the wheel. We're going to sell cash secured puts. And really, if we win, we'll just keep selling cash secured puts over and over and over again. And most of your cash secured puts are not going to finish in the money. You're not going to get assigned on them. Probably depending on the deltas of the put, depending on how far out of the money you sell them. Well, on mine, I typically go, around 20 deltas or so. I'm going to win more than 80% of the time probably on my cash secured puts. So 80% of the time plus, I'm going to sell these puts and I'm just going to win. But, about 20% of the time, I may end up getting assigned on these. And if that happens, well, now I have to buy 100 shares of that stock at the strike price of the put I sold, which again, because I sold an out of the money put, I'm actually buying these shares at a discount from where they were originally trading. So that's a put positive, right? That's not a negative thing. So now I have 100 shares of long stock. And then I start selling covered calls against now my 100 shares of long stock. And I keep selling covered calls. Most of them are going to win. So I'll sell covered calls over and over and over again until finally one of these get assigned. When you get assigned on a short call, it's the opposite of a short put. When you are assigned on a short put, you have to purchase 100 shares. When you're assigned on a short call, you have to sell 100 shares. Well, I already have 100 long shares of the stock. So when I get assigned on the call, all I have to do is sell the shares I already had anyway. And then we're back to square one. We're selling cash secured puts again, right? The wheel just keeps on turning. So that is the wheel strategy in a nutshell. Let me go back to the chat there. Yeah, Andreas is in the chat. Yeah, how's it going? And we get about 13 people watching. Yeah. All right, back to cash secured puts, because obviously this will be what you spend most of your time with on the wheel strategy because it's the first thing you do. And like I said, you're going to win on this an overwhelming majority of the time. Sometimes I may sell 6, 8, 10 or more cash secured puts on a stock I plan on running the wheel on before I ever get assigned. So, it's, rarely are you going to sell a cash secured put and get assigned on that very first one. A lot of times you'll collect, again, half a dozen premiums, 10 premiums, maybe even, selling cash secured puts along the way before you ever get assigned the stock. So the cash secured puts, you should only pick stocks that you would not mind owning for a considerable length of time if you were assigned. And this is one of the questions I get asked the most from newer traders asking about the wheel strategy. A lot of people go and sell puts on anything and everything they can find, which is fine. The short put strategy is probably the most common, one of the most popular option strategies out there, but you're not necessarily wanting stock in many of those cases. In this case, with the wheel strategy, the way we're doing this is we're selling a put with the intention of taking assignment if we need to. So in this case, do not do this on a stock that is not a good stock, right? We want profitable companies. We want real companies. We do not want meme stocks. We do not want penny stock garbage. We do not want stocks in sectors that are badly beaten up and look like they're all going out of business. So don't do like any of the pharmacy stocks right now. Walgreens, that's not something I want to be selling cash secured puts in. Most of the retailers, like the old department store retailers, most of them are near bankruptcy. I'm not selling cash secured puts in Macy's and Nordstrom's, whatever else is out there. I'm not doing that. So just be smart. What are the big companies that are really driving the market higher all the time? Well, it's the companies It's Apple. It's Microsoft, Meta, Amazon, Google, Tesla, Netflix, Coinbase, Broadcom, AMD. Just to name about 10 right off the top of my head. Everything I just named, very good companies that are not going bankrupt tomorrow, right? Those are the big names, right? That's what you want to sell cash secured puts in. If you plan on taking shares and running the wheel, you want to make sure that if you end up having to hold shares of a company, you want a good company. 99% of the publicly traded companies on your major stock exchanges, like the New York Stock Exchange and the NASDAQ, are not good companies. They're not the kind of companies, at least for me personally, they're not companies I want to hold for the long term. Right? There's just a small percentage of things that I really don't mind owning for the long term. Don't mind holding shares of Nvidia, right? I don't mind holding shares of whatever, Google. I don't mind some other stocks that I like to run the wheel on, or at least here in the past few years. Some of my favorites have included AMD. Coinbase is another one that I've had a lot of good luck with in the past. Right now, Coinbase is a very high price stock. Actually, right now, all of your stocks, the major ones like the Mag 7 stocks, they're all near all-time highs for the most part. But still, they're the good companies. That's the ones you want to be playing. A lot of people try to have this contrarian mindset where they look for the most beaten up stock they can find. Then they'll go sell what they call a cash secured put, and they're going to take assignment of this crappy stock that's done nothing for the last 5 years but go down every day. And then when they get assigned on it, or when they're about to get assigned on it, they freak out. Man, I really don't want the shares of this thing because I thought it was going to go back up, but now I'm about to get assigned on it. And now I was wrong on direction. Again, with these things, make sure it's a company you want to own. Too many people get into this thing and they pick the wrong companies. Now, I'm not saying you can't go sell like a naked put in something like a Walgreens or one of these retailers that's beaten up, like a Macy's or something. You can certainly go sell a naked short put in it with the assumption, hey, I'm either going to guess right and win on the trade, or if it goes against me, I'll just close it for a loss as far as a cash loss. I'm not taking shares. You certainly can do that. But if you plan on taking the shares of a company, make sure it's a company you want to own. So typically you want to look for things that are profitable, things that the stock tends to go up over time, right? You don't want stocks that are just in free fall for months, years, decades in some cases. That's not what I'm trying to wheel. I'm also never going to sell an option on anything that doesn't have good liquidity, right? We're not playing meme stocks. I don't want to do GameStop or AMC or any of that garbage. You're going to get killed trying to play those things. It's not worth it. Stick to the good companies. So for me, I like growth stocks. Growth stocks, they're typically tech stocks. The growth stocks are the ones that tend to outpace the market. They're the ones really leading the market higher because really it's tech that drives the market higher. As far as, there's like 13 major sectors of the market. It's really one sector, the tech sector, that pushes all the growth in the market. It's the reason, the S&P and the NASDAQ go up every day. It's all because of those tech stocks. They're the ones where all the action's at. They're the ones actually going up in price all the time. Most of the other 12 sectors, not so much, right? They kind of lag behind. Things like utilities and industrials and energy and consumer staples, they may go up a little bit over time, but not nearly at the same pace as tech stocks. So for me, again, I like those tech stocks, the growth kind of stocks, the ones that typically are really outpacing everything else. So the biggest risk with the wheel, getting assigned shares and then the stock goes down and never recovers. Like that's the biggest fear, because you get assigned shares at whatever price and the stock keeps going down. It never comes back to the price that you had to purchase those shares at, so you can never get out at a break-even price or at a profit, right? You're basically stuck in a losing trade forever. So because of this, I like to sell my cash secured puts out of the money, right? I don't like to do them at the money. I certainly would never do them in the money. And when I talk about out of the money, in the money, at the money, what does that mean? Oh, if you're new to options trading, let's go to SPY here. So this is the S&P 500 ETF. When we talk about an options chain, the way options chains typically are set up is you have your puts on the right-hand column, your calls on the left-hand column. Typically, they are price descending upward, ascending downward on the options chain. That's how they're typically displayed. Well, back in the day when people would print these in newspapers, it's the way they've always been set up. This is the way you typically see it online on websites that display options chains. Now, sometimes in your trading platform, you can rearrange some of this. For example, if I wanted to, I could rearrange where the strikes are going the opposite direction, where they're ascending upward and descending downward, but because that's not the way it's typically displayed everywhere else, it can be confusing if you start changing things. So I would just leave it the default setting. So at the money, the at the money option is the option that is closest to where the stock is currently trading. So right now SPY is trading at 605.43. 605.43, the closest strike is the 605 strike. That's the at the money option. And that's the at the money put. On the other side, that'd be the at the money call, the 605. We call that the at the money option because that's the one right now closest to where SPY is currently trading. Now, if I start going this way on the put side, I'm in the money. So the other side of at the money here is in the money going up on the puts. Well, it's actually down in direction, but you see we're going up in strike price. So these are the in the money options. If I go this way, these are the out of money options, right? So the at the money option typically is right around the 50 delta mark typically. You know, it's going to be somewhere around 50 deltas. Anything lower than 50 deltas is out of the money. So 47, 46, 44, all of these are below 50. These are the out of money options. Anything above 50 is an in the money option. So, you know, 51, 53, 54, 50, anything above 50, that is an in the money option. So this was the put side. The same thing on the call side. All of these options here, 50, 57, 58, 60, all these deltas here above 50, that's the in the money calls. And then everything below 50 on this side, these are the out of the money puts. If I clear all this. Now, one neat thing on Tasty is they actually have these 4 quadrants colored slightly differently. It may be hard to tell, but you have these darker colored black quadrants, this one here and this one here. These are the out of the money options, right? These are the out of money puts. These are the out of the money calls. And the lighter quadrants, it's the in the money calls. It's the in the money puts. Well, that is in the money, out of the money. Where do I like to sell my cash secured puts? I like to sell mine, you know, I've said earlier, around the 20 deltas, typically, you know, somewhere in that neighborhood. A 20 delta put, short put, is going to typically have at least an 80% chance of winning. Sometimes it may be a little higher. In this case on SPY, a 20 delta put right now has a chance of winning about 83% of the time. And that's why I like going out of the money for my puts. It's because I have a higher chance of winning. If I start getting closer to the at the money put, you know, maybe I only go to the 46 delta mark. Well, now I only have a 64% chance of winning, right? The at the money option is going to get closer to 50%. It's 63%. But if I started selling things that are in the money, like the 70 delta option, I only have 56% chance of winning. It's going to keep getting lower. It's going to get so low that it'll get to the point where I'm going to lose more than I win. I like to win more than I lose. So I never sell at the money or in the money options. I always go out of the money. And again, typically I just kind of default to somewhere around the 20 delta mark. Back to the chat here. See what I missed. Yep, everybody be sure to thumbs up the stream. Agreed, James. Appreciate you pointing people to the thumbs up button. Yeah. I have made 15 completed wheel trades so far. It's literally the only strategy left that I have 100% win rate on since starting my options journey. Good stuff. Yeah, you're going to have a pretty high win rate. Because most of the options you sell are going to win just outright, and even the ones that don't, so you get assigned the shares. If you're trading good companies, right, companies that tend to go up over time anyway. You may be in some of them for a few weeks or even a few months, but no matter what happens to their stock price, even if they have a really bad earnings event and go down 20, 30%, well, if it's a good company, good companies tend to eventually rebound, right? The bad companies, and this is why we avoid running the wheel on bad companies, the bad companies are the ones that have a bad earnings event, go down 30%. And then the next earnings is even worse. They go down another 30%. And then the next earnings is still another bad. Like, those are the companies that just do nothing but go down. That's the ones you don't want to get trapped in running the wheel on. But all the big companies, the companies you know, the companies you deal with in life, I have mentioned this on camera before. Now, what companies should I wheel? What are the stocks I should wheel? Well, trade the things that you see every day, the companies you interact with every day. You know, where do you shop? You know, if you're like most people here in the US, you're probably the biggest retailers in your area are Walmart and Target, both very big publicly traded companies, very profitable, real companies, not going out of business, right? They're doing just fine. You could trade those. The food places you eat, McDonald's, MCD, you know, that's a real company. I have no problem trading that. I leave later, I'm going to have to fill up on gas on my car. I'm going to have to stop at a gas station. You know, trade things like Exxon Mobil and Chevron, right? Those are real companies, big companies. I bank, you know, wherever you bank, but chances are you probably bank with a publicly traded bank. Some of the largest ones in the U.S., many of you guys probably use JP Morgan, Bank of America, BAC. Some of you may have accounts with Citigroup, which is the ticker symbol C. If you have MasterCards and Visas, MasterCard, I think, is, what is MasterCard? MA, I never really trade it. Visa is V. But there's a lot of things. The things you interact with every day, and they're well-known companies that have been around for decades in some cases. Yeah, trade those. Obviously, most of you guys shop with Amazon. Amazon, one of the biggest companies in the world. Most of you guys have computers. What's your computers and mobile phones and all? Probably a lot of stuff by Apple and Microsoft, right? And Google, right? Those three companies, the $3 trillion companies, right? Those are all good things that you could run the wheel on. So just, again, don't go pick anything weird. If it's a ticker symbol that is something you just discovered yesterday, don't start trying to wheel that stock. That's probably not something you want to own shares of long term. Because again, most companies don't go up over time. Most companies go down over time. Most of the companies that are publicly traded are not good companies. Yeah, I've started keeping ETF shares and keep rolling out calls. Yeah, that's the best things to run the wheel on are ETFs. Your index ETFs, which are going to be SPY, QQQ, IWM, things like that, or your sector ETFs, things like XLE, XLU, you know, things like that. You could do the gold miners is another one. GDX is a good one to play. There's a million ETFs. I could actually go to one of my watch lists here. If I go back to the Tasty platform here, I've got a watch list I created here called ETFs. I mean, I could sort it alphabetically here, but you know, ARKK. I'm actually in a trade right now. That's why it's got this dot under it. I've got a strangle on. That's an ETF, a basket of stocks. Not something necessarily most people would want to hold long term, but because it is a basket of stocks, it doesn't have single stock risk, at least, so it's less risky than owning shares in a single company. So I play that one. GDX, I'm in a position in that right now. The gold mining ETF. GDXJ is the junior gold miners, so the smaller gold mining companies, where GDX is the bigger gold mining companies. JETS is the airlines ETF. I currently have a position in that. The Qs, of course, is the NASDAQ. SMH is the semiconductor ETF. So that's your NVIDIA, AMD, Broadcom, all of that. Let's see if the chart loads here. Yeah, that ticker didn't want to load. Of course, all your sector ETFs. So XHB, the home builder sector, I've got a position in. We've got a position also, looks like, in XLE right now. That's the energy sector. XRT, the retail sector, is one I play on occasion as well. XBI is one I play on occasion. XBI would be the biotech sector. So yeah, all of these, really good wheel candidates because they're a basket of stocks, so they're less risky. They're not the thing, they can't go bankrupt, right? An entire sector of the market doesn't go bankrupt, right? Or an entire index like the NASDAQ doesn't go bankrupt. That's why you have no, you have much less risk on something like the Qs than trading a single stock like Apple, for example. And I don't think Apple is a risky stock, but still, a single company does have more risk than the entire market, such as SPY or the Qs. I've got some folks over on Discord. Somebody in the Discord chat was asking, does anyone just get booted from TASTYTRADE? No, I'm actually on the platform right now. If that person is listening to the stream, everything seems to be fine for me. He may be having networking issues at his house or something. It may not be a problem on Tasty's end. Yeah, basis still below calls, just feels safer, resistant to small correction. Yeah. I notice that some chains have around a 1% premium to collateral return or a 30-day 20 delta option, but others can have much higher. Yeah, the buying power on your options are going to vary. In some cases, very drastically, depending on the underlying product. Some products just always have a higher buying power. I can tell you from personal experience, things that I have traded on occasion in the past, but I typically avoid because I know they have high IV. A lot of the ETFs that mirror futures products, for example, GLD. This is a ETF. This is basically, it is a mirror of the gold futures. So it's like trading the gold futures, except as an ETF rather than as a futures product. This thing has really high buying power. It's a $243 stock. I go to the 65-day cycle and sell a 20 delta put. We'll do the 19 delta put. Buying power reduction on this, $3,700. Now, it's an expensive stock as far as it's $243 a share, but that $3,700 number is really higher than what I would expect even at that price as far as the share price. Other ones, TLT, which is mirroring the long bond futures, so like the 30-year bonds, which would be /ZB. TLT is a good way to trade this in ETF form. It's only a $90 a share ETF here. But if I go and sell a 20 delta put in TLT, buying power reductions $1,400. That seems, again, it seems a little on the high side, so I'm not crazy about these. KRE is definitely one. This is a regional banking stock, only $63 a share. I go and an example, 20 delta put on this, nearly $2,000 buying power. That's outrageous. I mean, for a stock that is $63 a share. That is insane. I would never pay that. I can go put that same amount of money to use in 3 other positions rather than just that one position in KRE. So yeah, the buying power does unfortunately fluctuate based on the products. I just know a lot of those ETFs, especially the ones that mirror like the metals futures, gold and silver, and the ones that mirror the bond futures like TLT, a lot of those things. USO, it mirrors the oil futures. It's another one, has crazy buying power requirements. That's why I typically don't trade those. Sometimes you will get individual stocks, especially kind of the meme stocks that really move around. Your broker is going to require you to put more buying power up for those. Typically, you shouldn't be playing those anyway. I don't think, just being a responsible trader, don't play any of the garbage meme stocks. But if you do, chances are your broker is going to make you put up more money to hold that position because the broker is taking some risk allowing you to put on that trade, because if the stock does something crazy and you can't pay, the broker would be on the hook for it. So typically your broker on really risky stuff is going to make you put up more money. Back to the chat. Yeah, the few companies I'm starting the wheel pay dividends. Bad idea. It's it depends. if it's like a blue chip, high paying dividend stock, just know this, those kinds of stocks typically don't go up in price. The reason they don't go up in price is because the stock pays a really high dividend. Where does that dividend come from? Well, the dividend comes from the stock price, right? Yeah, if you're new to, especially if you're new to trading stocks, especially dividend stocks, some people are confused about this. Dividends are not free money. How does the company pay you a dividend? Well, it's coming out of that share price, right? So if they're going to pay you a $2 dividend, that quarter or whatever, and the stock's currently trading at $100 a share before they pay the dividend, once the dividend is paid to you, the next day that stock's trading at $98 a share, right? So the dividend's coming out of that share price. So just know that. I mean, you're getting paid either way. I mean, I guess, do you want the money now to be paid as a dividend, or would you rather have a stock appreciate in share price over time? Typically, if you're holding shares for the long term, it's better to have the stock actually appreciate in value more than paying you a regular dividend. But of course, that depends. If you're somebody that's older, that's already acquired a lot of money sitting on dividend paying stocks just for regular income, maybe what you want to do. If you're younger, though, typically trying to worry about dividends is not something you want to do. You're going to be much better served finding things that are going to appreciate substantially in value rather than pay a dividend. So you're going to invest in a lot of the tech stuff, maybe invest in like QQQ, the NASDAQ ETF, right? Because that thing is probably up, I don't know, 30-something% this year. I actually haven't checked it for this year. Last year, I want to say the Qs had a 47% return, right? You're not getting anything like that with dividends. So, of course, that doesn't mean that the Qs would go up every year. It may go down 20% next year, but over time, typically it's going to go up more than it goes down. So there's a little risk to it, but also it's a much higher reward to it as well. The more risk you take, the more reward for, I mean, that's the way it is. You get nothing for free. So if you're younger, I wouldn't worry about dividends at all. That's not where you're going to make a lot of money. If you're older and you're trying to just have things a little safer and just for regular steady income, then dividend stocks make a little bit more sense. Yeah, the few companies, let's see, I've already read that. You should be looking at return on capital when selecting. If you can get $100 out of $1,000 buying power, that's decent. If you can get $100 out of $2,500 buying power, not so good. Yeah, that's pretty much how it works, James. How I think about it. I know where I typically sell my my puts. Now it'll vary because I don't always sell the 20 Delta put, but let's say I'm in that general ballpark. If I sell something for $1, if it has $1,000 buying power or less, that's pretty good. If it has like $1,000 to $1,500 worth of buying power, I would say that's okay if I really want to trade something. If it's $1,500 or more, and I'm only receiving $1 credit, yeah, that's on the high side. Like I can probably go find something better to trade. I'm just throwing those numbers out there, but I can go, there's plenty of puts I can go sell right now, 20 Delta puts and various things where I receive at least $1, and I can find things that only have a buying power reduction of $600 to $700. And there's several things. I could go find that right now. So if I have that opportunity out there, why would I go collect $1 selling a 20 Delta put in something that wants $1,500 buying power? Doesn't make sense. So that's, yeah, you're right. That's kind of how I think about it. Yeah, I've been trading ETFs more than individual companies this year. Yeah, I think the more experience you gain as a trader, most people start doing that. Most people try to get away from the single stock risk, especially with earnings, or the CEO of UNH the other day got assassinated, caused the stock to collapse, or Boeing's planes all of a sudden start falling out of the air and Boeing collapses, or many years ago, Steve Jobs announces he's got cancer and, Apple stock collapses. Whatever the event is, that single stock risk, people try to get away from that eventually because you get burned too many times by it. So naturally people the more experience you gain, you're going to gravitate to ETFs or to futures products or a combination of both. I trade a lot more ETFs and futures now than I did, 5 years ago, for example. And many people get to the point where they just find a handful of things to trade regularly and they just stick to the same products. There are many single product traders out there, which is kind of crazy to think about, but there are many people that all they trade is the S&P 500. However, they happen to trade it, the ES futures or the SPX index or whatever it is they're doing, SPY. And there are many people that's all they trade. They find the one product, it's very liquid. In this case, obviously the S&P 500. You got all the liquidity you want, plenty of people to trade with, and that's all they do. Yeah, why would you not want to buy options in a DTE where theta decays the fastest? So theta decay hurts long options. So I'm not, okay, you meant sell options. Okay, I thought you might have been confused. So why would you not want to sell options in a DTE where theta decays the fastest? So theta decay really starts ramping up in the last 2 months or so. So 60 DTE, kind of where I typically sell my options. I go about 60 DTE. And then, theta starts becoming a thing, right? It really starts ramping up, ramps up all the way, heading to expiration. So, I mean, that's kind of where you want. Now, you might can collect a lot of theta by holding all the way to expiration, but typically that comes with a lot of other risks. That comes with delta risk, directional risk. Typically, you don't want to hold an option all the way to expiration. So the sweet spot for me is I sell about 60 DTE, and then I close the position, manage the position at 21 DTE. So at most, I'm only in the trade. In this case, that would be, 60 minus 21, 39 days. Assuming that I don't get out of it earlier than that. Now, I would say 80 to 90% of my trades don't make it to 21 DTE. I'll sell a put at 60 DTE. Most of the time, I'll win 50% or more on that put within a week or two and close it, and then sell another one. But yeah, obviously, theta further out in time is less of an effect. Closer you get in, more theta you have. That's why typically when you're selling options, you're doing it, a little bit closer as far as a time frame. You might go out 60 DTE, maybe even go out 90 DTE, which is 3 months out past that. Theta is not as big a deal. That's why when people buy options, they typically go out way out in time, like a leaps options. They'll go out and buy a leaps call like 1 year out in time. It's because theta is barely working against your long option that far out in time. Where shorter dated options, that's typically when you're selling options. Not all the time. That's very generalized what I just said, but that's typically, when people are selling puts, for example, they're typically doing it in a 30 DTE, 60 DTE kind of time frame. When people buy options, they're typically buying leaps options really far out in time. Yeah, when the market is going up relentlessly, I bought shares first, then immediately sold calls for margin of safety. Yeah, you can keep the dividends that way. Yeah, how's the liquidity on the micro futures options? Liquidity is fine in some of them. And when I say some of them, liquidity is fine in MES. This is the only one. I got a million MES positions on right now, but the micro ES, liquidity is okay. It actually trades. The other micro futures, MNQ, the micro NASDAQ, liquidity is a problem. I sometimes trade it. As a matter of fact, I've traded it half a dozen times this year, but it is not nearly as liquid as MES. Now, you've got some wide bid-ask spreads here. So, yeah, I wouldn't trade MNQ personally because there's when it comes to the S&P and the NASDAQ, you've got so many products to choose from. So with MNQ, I just skip it altogether. Go trade the NQ if you have an account big enough, or do defined risk trades in NQ if that can get you small enough, or go trade. This might be one where you go to the ETF, QQQ. QQQ is extremely liquid. No problem trading this at all. So yeah, if you're talking about the micro ES and the micro NQ, yeah, the micro ES is fine. The micro NQ, not liquid at all. I just avoid it. There's no other options on most of the other micro futures. The only ones I know that do have options, MCL is the micro crude oil. Not very liquid either. I go 58 days. Actually, the bid-ask spreads here, 11 cents, 12 cents. It doesn't look too bad. Open interest, though, open interest is really, really low. Really, really low. So, yeah, liquidity is a problem. MES, you're fine on. Everything else, as far as the micros, as far as options, not good. Now, if you're just buying or selling the futures contracts themselves, all of the micros are fine for that. They all trade as far as the futures themselves. They're all liquid enough. But the options, only MES is good for you. So that was cash secured puts. I got off on reading the chat there for a while, but in cash secured puts, I sell cash secured puts. Typically, I typically go about, well, in this case, I recommend 16 to 30 deltas. I already said typically I go around 20 deltas, but I can play with that number a little bit depending on whether I want to get a little further out of the money or get a little closer in the money to get a different kind of credit. But 16 to 30 delta is a good general range. 45 DTE. Now for me, I like going a little further out. So a lot of times I'll go 60 DTE, but always manage 21 DTE. Like you want to get out early. You get out early, you make more money. I know that a lot of new options traders often ask this. Why don't you just hold to expiration? It's actually better for your P&L if you manage your trade early. Meaning if you hit 50% winner, take it off. Lock in a win. It's always better for your P&L. If you get a winner, take the winner, right? The more profits you lock in, the less you're going to have that trade turn around on you in a big way and really, cost you a lot of money later. So take 50% winners off always. And no matter what, winner, loser, scratch, at 21 DTE, the trade's over. Take it off. However it ended up happening, that's it. Move on to the next trade. You don't want to hold on all the way to expiration because then that comes with risk. That's when you could get into some weird situations where, you were up on the position a little bit, but you didn't want to take it off. You held the expiration. Now you're down hundreds of dollars, thousands of dollars. Now on a cash secured put, you could take assignment of the shares. And that may be what you're doing. If you're running the wheel, that's what you want. So there's nothing wrong holding all the way to expiration if you want the shares. If you don't want the shares, get out at 21 DTE. Yeah, 21 DTE is usually a Friday. Why not 18 DTE and hold over that weekend? I mean, it's just a number, 21 DTE. If you want to go something slightly different, that's fine. The point is you want to get out well ahead of the expiration. You don't want to, you definitely do not want to hold that last day or two, especially. It's a lot of delta risk, gamma risk, P&L swings, especially if that stock is trading right around your strike. I mean, the slightest movement is the difference between that thing being up a few $100s, down a few $100s. You don't want that in your life, right? So just make sure, 21 days, 18 days, whatever. This is the same. You're still out well ahead of all of that happening. Now, why 21 DTE? That's just a rule that the Tasty guys came up with. They push that, and I like it because it is a Friday. Friday expiration. Your monthly expirations typically are on a Friday. A lot of things just happen on Friday, so Friday is just the day you manage things most of the time. But you could certainly wait until Monday as well. For me, I like separating some of my regular trades. Like when I say 60 DTE, why did I choose 60 DTE? Because a lot of times that falls on a Monday, things like SPY and QQQ. So that's why I put on my trades at 60 DTE, because I do that on Monday. 21 DTE, you're right, usually falls on a Friday. So it's like Monday is the day I typically will put on some opening trades. Friday is the day I start managing things, maybe that need to come off or need to be rolled out in time. But again, either one is fine. No real difference in that. Now, the covered call part of this. So you get assigned on a cash secured put eventually. Now you have 100 shares of long stock per contract. but let's say you did one contract. Now you got 100 shares of stock. You start selling calls against your shares. Now, you got a really good discount on your shares, right? Because you were selling an out of the money put. Maybe you sold that 20 delta put, right? So you eventually got assigned at a discount on a stock you really wanted to own. This is great, right? Now you need to figure out what is your cost per share on the stock you own, because you eventually are going to want to get out of this trade and you want to know the number that is a profit. So you need to know what your cost basis on the trade is. So you have to add up all the credits you received from selling puts along the way. So if you sold a 20 delta put for $1 and you got assigned on that put, so that's the only put you ever sold, you got assigned on it, and that put, the strike was $100. Well, you had to buy 100 shares of ABC stock at $100 per share, right? That's $10,000 worth of stock, but it's $100 per share. But what is your cost per share? Well, if I got $1 for selling the put in the first place, $100 that I purchased the stock, I got to subtract the premium, $1 I collected along the way. My cost per share is really only $99, right? So remember, whatever price you buy the stock at, your cost base is actually a little less because you received a credit also for selling that put, or in some cases, multiple puts along the way. So a lot of times your cost basis is actually considerably lower than what you actually bought the stock for. Matter of fact, much of the time when you get assigned, if you sold a lot of puts along the way, you're already able to profit by just turning around, selling the stock that you just had to buy anyway. You could turn around and sell it and still be up overall on the trade because you received so much credit along the way. So make sure you figure out your cost per share. Once you know the number that you need to hit in order to make a profit overall on the trade, make sure you sell calls above that number. I hope that made sense. For covered calls, I typically do these in the same kind of delta, 16 to 30 delta range. Now on the calls, typically you have to lean in a little more than on the puts. So on this, like 30 delta calls are kind of the norm for me. I'll sell 30 delta calls. I typically go 14 to 21 DTE. So these are much shorter dated, and the reason is for covered calls, I don't worry about expiration. So if I sell a 21 DTE covered call, I'm holding it for the full 3 weeks most of the time. Well, not most of the time. A lot of the time, you're still going to win on the call. If I get 50% winner on the call along the way, I'll take it off, sell another one, just like you do with the puts. But if I don't get 50% winner on the short call, well, I'm only in the trade for 3 weeks. I just leave it on for 3 weeks at 21 D or at 20 after 21 DTE after expiration. I'm either going to win 100% on the trade and keep the premium, or I'm going to get assigned on the trade or lose my shares, still get 100% of the premium on the call. Either way, there's no real risk of risk of holding a covered call all the way to expiration. So in that case, that's why I treat that a little different. So what I do, I typically, if I reach 50% max profit at some point on the trade, I'll take it off, especially if I reach 50% max profit, say before 7 DTE, with at least a week left on the trade. Now, if I reach 50% max profit with 2 DTE, then I may just go ahead and leave it on because there's so little time left in the trade. I might as well hold out and see if I get 50% or 100% of the profit, right? But if I get 50% of max profit in a reasonable amount of time early, I'm always going to take the winner. Always lock in the winner. Again, it's better for your P&L anytime you can lock in a win. Hanging out in a trade longer than you really need to hurts your P&L because you're going to have a lot of winners that end up becoming losers because you held on to them too long. So a little bit about the wheel strategy. So anybody got any questions about any of that? Short puts, covered calls, even the stock portion of it. Let's see, James, some very helpful images regarding the analysis of DTE in DT's Discord. I just resurfaced them. Be sure to join the Discord. Yeah, go check out the DT Options Discord. If I go to the Discord here, Yeah, some images here that James just posted. Take a look at this. This is duration. And what he is describing here, it looks like this is the decay of a 16 delta SPY strangle. So this is a short strangle on the SPY, your standard, one standard deviation strangle. 16 delta put, 16 delta call, delta neutral strangle. There's a lot of theta in a strangle because you have two different short options, so you get double the theta. And how does theta work? Well, you can see 45 DTE. It's working a little bit, but it really ramps up, you know, later into the option cycle. Oddly enough, you do get this little dip right here toward the end, and then, of course, like the last day or whatever. The curve can be a little weird, but essentially just think of it in general as the closer you get to expiration, the more theta ramps up. And you see in this area here, the 45 day to 21 DTE, you get a pretty good amount of theta decay. Now you could hold out for all this theta decay too. Is it worth it? Not really. I mean, there is time value left in those options, but there's also so much risk that is not associated with time. You've got your delta risk, which is your directional risk on the trade. You also got vega risk, your volatility risk left on the trade. So if you can manage early, especially if at this point you're a winner, lock in the win, take the win, right? You don't want to hold on for this little bit of theta value because, again, you've got delta risk and vega risk always out there just hanging out, ready to knock you down. In this chart here, duration and theta decay, similar kind of little graph, shows how it wraps up 200 days out, you know, and then 0 DTE. You see how it really starts dropping. 200 days out, so you're talking, you know, going out, you know, 6 months or more, you know, you're getting into leaps kind of territory. You know, theta's not really a problem here. Theta's a problem here, right? If you're a long an option in this general area, 50 days to 0 days in, right? A long option is getting punished every day by each day that passes. Really hurting the value of that long option. Out here, not so much. And of course, many people going out a year or more on their leaps where theta is really not much of a factor at all. Yeah, thanks for sharing those charts, James. Appreciate that. Yeah, does DTE include Saturday and Sunday? It does. And the reason it does, even though the stock market doesn't trade, you know, and the futures markets don't trade on Saturday or Sunday morning either, but time value is still baked into those options, and the time value baked into those options, part of the time is those Saturdays and Sundays, even though stock's not trading those days. Those days do make up a considerable amount of time value in that option. When I sell a 60 DTE put, right, there's a lot of Saturdays and Sundays worth of time built into the value of that put. So yeah, they do count. Yeah, theta typically includes the weekends, but the options typically price this in. Yep, you know, it's all priced in. You know, holidays, you know, we're about to have a holiday next week. You know, obviously the stock market is going to be closed Christmas Day. Stock market, I believe, is going to close half a day on Christmas Eve, the day before. And then the next week, New Year's Day is a market holiday. You know, the market will be closed. But whatever trades you have on that go past through those days, yeah, all that time value, those are calculated in the DTE and all of that. A 2-minute warning to the FOMC. Well, we know the FOMC decision already. It's pretty much guaranteed they're going to cut. That's not likely to move the market. What's going to move the market is when Jay Powell starts talking in about 30 minutes. I probably won't be on, you know, that much longer. So, but yeah, in about 30 minutes is probably when things are going to move around a little bit in the market. Let's pull up a little grid here. Now, the ES, NQ, RTY, VIX futures, nothing really has changed. It's really been a kind of a boring trading day. As far as nothing different now than when the markets first opened this morning. If I take a look at, well, let's take a look at the ES. 1 minute chart on the ES, and we'll see here in just another minute or so. We get some movement. Hi, if most of the decay is at the end of the option life, why manage the sold put at 21 DT? Well, I just said it's because there's other risks that are more dangerous than that theta component. You know, the little bit of theta you get in those last 3 weeks is probably not worth it for the delta risk and gamma risk on the trade. And if it's a short options trade, Vega risk is a real thing too. So the delta risk, what I'm talking about, is the directional risk on the trade. Because if you hold it till very late in the option cycle, especially if that option's just somewhere right at the money, the slightest dip up and dip down of that stock is going to be the difference between you being in the money and out of the money. That's gambling. That's a roll of the dice. There's so much randomness involved in that. You don't want to, trust me, you don't want to deal with that. Get out at 21 DTE. Things are just a lot saner, just easier to deal with. Yeah, you might squeeze out a few extra bucks on Theta holding to expiration, but you could potentially lose many, many more bucks because of much greater risk with that delta/gamma risk late in the option cycle. Not to mention, if it's a situation where you're selling a put, for example, on a stock you don't want to own shares, you can't hold to expiration. If you hold to expiration, you could get assigned shares, so you got to get out early. Yeah, I guess the Fed rate decision just came out. It's a non-event. I mean, that candle looks big, but the market was barely moving. So looks like an exaggerated candle, but it's not, because the market just been trading sideways all afternoon here. It's only about a $15 or $20 move in the ES. That's a nothing move. And chances are here in a minute that's going to come back. Right? That's just the first jog down. It'll probably reverse in another minute or two. Probably be right back to about where it was at. Really, the movement, when Jay Powell speaks, you know, depending on what he says, like if he gives some kind of crazy guidance going forward that nobody expected, that's what's going to move the market. Yeah, James, yeah, they cut as expected, yeah. I mean, it was a pretty much 100% guarantee, so yeah, nothing to see there as far. That's why we didn't even talk about it this morning as far as the FOMC meeting. We kind of knew what was going on with it. It's kind of a non-event. Yeah. Yeah, you can see, yeah, and then the market's just not doing much now. Back to what it was doing before. These small little sideways candles here. Yeah, so now the ES is down 4 on the day, essentially unchanged. NASDAQ down a little more, down 73. Russell only up about 380 now. So they're all a little lower after the announcement, but just a little lower. Again, essentially not much going on today. Just taking a look at some of my positions. Anything, I really didn't have any trades today. In our Discord meeting this morning, I didn't put on any opening trades. I didn't put on any closing trades. I do want to say, though, Micron reports earnings after the bell. We didn't talk about this morning in our voice chat on Discord. What should I do in MU? MU is well off its highs. All the semiconductors, and the semiconductors have been kind of beaten down here in the last few days. Yeah, I do trade on Linux. Yeah, this is TASTYTRADE running on Linux. Yeah, I do everything on Linux. I don't have a machine that doesn't run Linux. I haven't used Windows in nearly 20 years, and I've never owned a Mac. I'm not a fan of Apple, the company. I trade their stock, but I don't buy any of their products. Micron, MU. Now, how would we trade this? Well, we've got an 85 IV rank. We've got IVX in the monthly cycles. I do the 30-day cycle. 69%, really high IV. So there's a couple of things you could do with this. Ideas. If you don't mind the risk and have a bigger account, you could certainly sell a strangle, because you're going to get a very nice premium. I probably lean a little bit on the high side here, because really the risk, I think, is on the call side. Maybe do something like the 90-145 strangle. That's 11 delta put, 12 delta call. pretty good wide range in the 30-day cycle here. Get 241 credit, buying power reduction of only $1,100. That's really nice. And if MU doesn't make much of a move, it can make a move. It just doesn't need to be anything crazy. If it makes a $10 or $15 move in either direction, be well inside this strangle, volatility is going to come down. And that volatility coming down is going to pay you. You know, you're going to make money on volatility contracting on this strangle. Now, what's going to kill you is if for some reason Micron makes some crazy move, like it goes up $50 or it goes down $30, then this is not profitable at all. It's going to cost you a lot of money. There's some risk in this trade, but again, you're getting paid to take that risk. Really good premium on a low buying power reduction. So that's one way to play it. If you wanted to do something defined risk, you know, the strangle's a little too risky, but you still wanted to play for that volatility contraction. Maybe you think Micron's not likely to make a big move. I'd do something like a iron condor. So let's do, see, the 90.85 on the put credit spread, and on the call credit spread, see what we'd get for the 140, 145. Not much. We're going to have to bring this in, or we may have to bring the call in a little bit too. I want to receive at least $1.25 or so. In this case, 134. So we're risking about 366 to make 134 on this iron condor, $5 wide on each side. That's another way to play it. If you had a directional assumption, you could do a shorter dated option. So instead of the monthly cycles, go into the 2-day cycle. What's your directional assumption? For me, because MU is definitely well off its highs, it really hasn't done much in a while. Could this thing go up? Maybe. The way I might play this, I do this a lot in my Discord channel. A lot of times on these, I'll just do a butterfly spread. So I go to the expected move. On the call side, I sell right at the expected move. So let's imagine it goes up. And I'll go, in this case, go $7 wide. So I'll buy that call. Go $7 wide on the other side, buy that call. And then the one in the middle, double it up. You need 2 short calls here, and this is a call butterfly, a long call butterfly. Why is it a long call butterfly? Because you're paying for it. This is a debit trade. In this case, I would pay $66 for this, a really baby kind of trade, right? And this is what's great about this kind of trade. You know, options are great because you can make them as small or as big as you want. You can take as little risk as you want or as much risk. This is the kind of trade anybody could take. We're not risking anything. $60, right? Max profit on the trade, $640. You're probably not going to make $640 on the trade. The only way you make $640 if you hold this all the way to expiration, which is only in 2 days on Friday. But you'd have to hold it to expiration, and the stock finished exactly at 122. That's how you get the max profit. Realistically, you're going to close it probably tomorrow. If the stock makes a move up into our butterfly, you're probably going to make 100, 150, 200 bucks on the trade, close it as a winner and move on. I mean, if I spend, in this case now the price is $73, but if I spend 70 bucks on this trade and I make, you know, 100 bucks, you know, at open tomorrow on this trade, that's great, right? That's a winner. Again, a small trade, but you could size this. You could do the same thing. If you wanted to bet on this thing going down, you would do the same thing on the put side. You just do it with puts, you know, do a long put butterfly if you want to bet on it going down. In this case, I'll do the call side. Let's see if they'll give me this for $66. Just going to put that in. Markets on this is a little wide. Some of these options, the bid-ask spread, not very tight, 15 cent wide. In this case, 19 cent wide on those. But again, very small trade here. We're not risking much. I go up to $68, what I get filled? About $70. Just going to leave that in for a little bit, that $70 price. If I get filled on that butterfly, fine. If not, I may adjust it. But that'll be the one trade I made today. Typically, I make, you know, 8, 10, 12 trades every day. Kind of what I average. You know, I average about 2,500 options trades a year. Today, I was using plenty of buying power. I didn't need to put on new trades. I had no closing trades, no winners that needed to come off. So today was a little unusual in that I didn't have a trade at all today, and I saved this earnings trade just for this stream. For those not familiar with how a butterfly spread works, let's go to the risk profile. All right, well, I can't do the risk profile because I'm not filled on the trade yet. Oh, there it goes. Let me go. Well, just as I was about to tick it up a dollar or two, I got filled at the $70 price. So I did get filled at that price at $70. That was the price of the spread. All right, now let's go back to analysis. This is what a butterfly spread looks like. So MU's trading here. If tomorrow MU goes into this range here, we're going to make a little money. How much money? Well, let's go into this little sidebar here, go to analysis, and then go right here to the date, go forward 1 day to 12/19. The orange line is the T0 line. That means this is the price that you can expect of this spread here tomorrow, 12/19, if the stock is whatever the price happens to be. So if it finishes somewhere, if tomorrow we get here and we're trading somewhere in this general area, you know, somewhere in this butterfly spread, looks like theoretically I'd make about $62, $63. Now that doesn't take volatility into account. Volatility will play a role in this trade. I go back to the positions tab here. Let me move my head out of the way. You guys see I have Delta, Theta, and Vega here as columns. So Vega, let's see what volatility on a long call butterfly is. In this case, the Vega is essentially nothing. There's no volatility risk. You know, if volatility goes up, it's not going to hurt me. Volatility goes down, it's not going to hurt me. It's essentially zero Vega. Now, why is that? Well, in this case, it's because I've got 2 short options and 2 long options. The Vega on each kind of offsets each other, right? If volatility goes down, it's going to hurt these long options, right? But it's going to help the short options, so they kind of offset each other as far as Vega. Ultimately, though, we want to get direction right. We want to be in this range, and the longer we're in this range, the longer I hold on to it, the more money I would make if I held all the way till Friday morning. So not Friday expiration, but if I got out of it right at Friday morning, let's imagine the spread is somewhere in here Friday morning. Now I'm looking at a theoretical profit somewhere around $300. So the longer I hold it, the more money I make. Right? If I held on to it late into the afternoon, maybe tomorrow, might be $100, $150, $200 winner. But there is risk holding it all the way to expiration. Just like anything, don't hold it all the way to expiration, because you could get into a weird situation where the stock finishes in between your spreads and, you know, one leg gets exercised or assigned, but the other one doesn't. And you end up with a stock position that you really didn't want. Which isn't necessarily like a horrible thing, because you just turn around, you know, you get a sign, you know, all of a sudden you wake up Monday and you got long shares of stock or short shares of stock, whatever it happens to be. You just turn around, close the position on Monday, you know, and you're out of it anyway. But typically you don't want to fool with that, so get out early if you can. That's my earnings trades. I think that is it for the day. Gonna hang out with you guys just a few more minutes. Any quick last questions or comments? Anything about really anything, the wheel strategy, anything options related or trading related in general? Let's see. Yeah, you're a Mac user. You're a sucker for that old 5K display, huh? Yeah, Mac hardware is really nice. I don't like the software. Yeah, that's more my problem with it. Is I'm not a fan of the Mac OS, the operating system. The hardware I have less issues with. Yeah, Jamba says he uses Artix Linux, by the way. You forgot the by the way. I added it in for you. So James says, very nice. Yeah, on Artix. Yeah, you're going to check out Asahi because you like the name. Yeah, it feels like all the tech stocks seem to just go up no matter what after earnings. Yeah, hopefully MU works out. It's a 50-50 shot, right? I mean, if you're going to bet something going either up or down, maybe it will go up. I don't know. I have no control over it. Again, you can't predict where things go. I just picked a direction. I very easily could have put that trade on with puts on the downside. I had no reason to pick the upside, other than that's just what I went with. One thing, though, I will say, I say I don't have a reason. A lot of times, I will take a quick look at the stock, and if it's at the lower end of its range, which, I mean, it has been lower, but it's also been considerably higher. And I said the semiconductor sector, you know, here in the last couple of weeks, they've all kind of lagged behind. AMD is kind of lagged behind. NVIDIA been going down here lately. You know, it just makes sense. They're a little bit beaten up. So I picked the upside. That doesn't mean anything. It's a coin flip. You could have picked either one. Doesn't matter. Direction doesn't matter. Whatever direction you trade anything doesn't matter. You have no edge. Trying to pick direction, there's nothing to it. Just pick a direction and go with it. The other thing, a lot of times when I pick direction on these earnings trades, it can sometimes depend on what the overall stock market is doing. Like right now, both the ES and the NQ, they are down on the day. So we are seeing a little bit of a sell-off. Quick look at the 1 minute chart in the ES. Yeah. So it has sold off considerably here in the last few minutes now. Yeah. So that is interesting. Yeah, so a lot of times when I see a day that's kind of a red day, you know, if I'm playing earnings directionally, now it won't matter for iron condors or strangles, but if I'm doing a purely directional trade like a butterfly spread or call debit spread, put debit spread, a lot of times I'll pick the direction, the opposite direction of what the market's doing that day. Not that that has any edge at all. It's just what I go with, right? Generally, directional trades, you have no edge. They're not trades I plan to make money on. This is just a fun trade. That earnings trade was just a small little fun trade, especially for those of you new to options trading. You know, you wanted to put on a relatively small, safe trade. Only cost me $70, right? It's a $70 lottery ticket is all that is. And what's the most you can lose on the trade? On a debit trade, the most you can lose is the money you put up. The most money you can lose on that trade is $70. So that's a nice little tiny trade. As an example trade, has nothing to do with the wheel trade. We're not running the wheel on MU for earnings, right? But that's the earnings trade for today. For those of you wondering about earnings the rest of the week, only other two companies that report this week that you might want to play after the bell tomorrow, FedEx reports and Nike reports. I'll probably play Nike. I may play FedEx too. FedEx, not as liquid. Nike's pretty liquid though. I like trading Nike. Yeah, you need J-Powell to say some nice words to bring this market back up. Down $750 on the day. Yeah, it's a small little sell-off though. And again, we're still at all-time highs, near all-time highs in the ES and the NQ. Even if this is what it's going to be the rest of the day, even if we finish down $300-400 in the NASDAQ by the end of the day, you know, it's a nothing little sell-off, you know. Because chances are tomorrow it's going to start going back up again. We'll just start the climb back up, yeah. And certainly the next 2 weeks, New Year's, Christmas week, and then New Year's week with the abbreviated trading because of the market holidays, you're only trading essentially 3 days next week. And then New Year's week, you're only trading 4 days. Probably light volume because even on the days that the stock market's open, a lot of people won't be trading. A lot of the professionals will still be on vacation. You know, I bet in the next couple of weeks, we just see a slow, gradual drift higher, probably low volume. Yep. Yeah, for sure. All right, guys, I'm going to get out of here. Thanks for hanging out with me on this live stream. This was fun. I needed to do one of these anyway, just to test out live streaming on this channel. So I don't know how regular of an event we'll do these. Obviously, I do the live voice chat in the Discord every morning for those of you hanging out in the Discord. So just for time's sakes, you know, I certainly couldn't do this on a real regular basis, but I'd like to do one of these at least, once a month, twice a month, do these on YouTube. We get a little bit of a different kind of crowd. Plus I can do this at a different time of day, which might accommodate other people that can't be around in the Discord in the mornings. So yeah, James says, I appreciate it. Yeah. Thanks for hanging out, James. Yeah. All you guys. Yeah. Andreas and Sam and all you guys, appreciate you. Yeah. Jamba.